Good morning, everybody. This is John Bratsakis, President and CEO of the Maryland DC Credit Union Association. First, I'd like to thank all of you for taking time out of your busy schedule. We know how hectic and crazy things have been over these last several weeks. Do want to thank you for taking time to join us for our third virtual town hall. We appreciate all of the attendance and all the engagement. Before we get started, I just wanted to let you know that we will be sending out a follow-up email, and I'll remind everyone later, just a quick request to help us update some of the numbers on some of the programs that we'll be talking about here later on today. So for today, we do have Congressman Anthony Brown will be joining us. He's going to be joining us a little bit later, so we'll slot him into our agenda as soon as he joins us. And then we're fortunate enough to be joined by the president and CEO of PSCU to give us some thoughts and updates on what's going on with cards and the payment industry. And then we also have Andy Schaffel from the Office of the Comptroller will be talking about some possible revenue outcomes and what's going on with the economy locally and some ideas about what could be happening going forward. And then we have the regulatory update. We're once again joined by John Cutchy, Regional Director for the Eastern Region, and also the Maryland Commissioner of Financial Regulation, Tony Salazar. And then we will have Norm Patrick from PSCU talking about card payment trends. And then finally, our partner, John Bredehoft from Kaufman and Knowles, will be giving an update on various legal issues, some updates on some of the new things through the CARES Act and HR related. So with that, I'm going to go ahead and turn it over to Chuck Fagan.
Good morning, everyone.
All right.
And good morning, everyone. John, thank you not only for having me on, but for the continued guidance and information you've been sharing. It's a pleasure for PSCU to be a partner of the Maryland DC Association, and we certainly appreciate all the support. Right now, actually, we're supposed to be at our annual member conference, so things have certainly had to adapt. And I thought what I'd share on the front end here is a little bit about how we've reacted, what we've done in adjusting our business to support our credit unions, and then I'll also talk some about payment trends, trying carefully not to step on what Norm will share from the Advisors Plus perspective. So, over the next 15-20 minutes, we'll cover that. And John, I'm planning to be on with you the entire time. So however you plan to do questions, we'll react accordingly. But, from PSCU's perspective, with 2,300 employees, many of those supporting credit union members, whether it be through contact centers or fraud detection units. In roughly 14 days, we were able to move about 75% of that employee base remote, and certainly some lessons learned in there. And we're now in excess of 90% of our employees in a remote environment, and there are areas that we really never envisioned being remote. Contact center and fraud detection rise to the top of that list. And it's just because of, opening up 40 million account numbers, and, even in an office setting, those are positions that we don't allow pen, paper, and phones in, just because of the confidential nature and the risk exposure with that account base there. So we had tested over time some applications that provide kind of a security layer over that. So push comes to shove, we had to put all that into play, and amazingly, and I've talked to many credit unions over the last several weeks, and we're kind of in that same position where hey, we pulled this off. This is worked better than we thought. And I'm hearing the same messaging from credit unions, and now I think is the time to be shifting the conversation a bit towards growth. What do we do as a credit union? What do we do as PSCU as we head towards coming out of this, to make sure we get our share of the growth? And than I think also we're doing, and I think prudent on credit union's part to do quite a bit of scenario planning, because it is going to be, a completely new space in that members are being trained to act differently now, given the environment, and specifically on the payments side, as we talk about ATMs and actual cash. What we're anticipating is that the large portion of transactions that are under, say, $15, that are still at least 50% cash, that there's going to be a tremendous push from the consumer to convert those transactions to card-based or mobile wallets. And are we ready for that additional volume that will come? And you start thinking about the number of those transactions and the repetitive nature as members begin to use that. Those smaller transactions probably drive top of wallet status. So what are we doing now, scenario planning as credit unions, as PSCU, to make sure that we get our card positioned at the top of the wallet? So some of those things will certainly shake out in Norm's presentation. But as we've gone through this shift back to the contact center, what we've seen, just because it's the channel that members have had to adapt to with really drive-throughs and lobby access by appointment only at many credit unions, is really a pretty consistent 30 to 50% overage in what our anticipated or normalized volumes were. And we've had spikes like last week when stimulus checks were going out, that the volume of inquiries into digital banking caused some outages, caused some latency in the provider's software, that call volumes actually got above 200%. So I'm anticipating that credit unions are seeing similar fluctuations in the volumes. And we certainly in time in history have always measured abandon rate. We've tried to answer at least 80% of our calls in 30 seconds or less. And during the pandemic, really the focus has been on average speed of answer. How do we make sure that is at a reasonable level? And it's certainly difficult when you see spikes in volume like that. But we all through different mechanisms, at least at PSCU, we intentionally have some employees get accounts at some of the larger banks, just so that we can track card offerings, loyalty offerings, contact center. So we've been placing calls to some of these larger FIs to see what their contact center wait times and stuff are, and really try and measure our business to make sure that credit unions are exceeding at a service level. And sometimes those calls to those larger FIs actually go unanswered. So the fact that the credit union member, whether it's calling the credit union direct or an overflow or utilization of PSCU's contact center, the member is getting an answer. We've actually had to separate our company into two teams. We use our company colors just as a blue-green to try and keep the work team separate. So example, in our St. Pete campus, we have two buildings, and the blue team goes into our 560 building and the green team goes into our 580 building. We actually adjusted badge access so that the blue team can't go into the other building and vice versa, to keep the team separate. If we had one case and ultimately had to shut down the few employees that are still going in, that would be devastating to us being able to handle the volumes. And also thinking along the lines of reentry, that when we come back, it's not going to be the same. It's not going to be like June 1 or June 15th, everything's okay and everybody can come back in. The reality is there's going to be a small percentage of employees that that make that initial entrance, and we'll have to keep them segregated or separated. And then over the next 6 to 8 months is probably, a fallback scenario. So what does that new normal look like, and be planning now for what reentry looks like. I think in our case, because we have offices all over the country, we're obviously having to pay attention to what the various states that we're in are doing, as well as, keeping a check on the localities that we're in. But, real push on our end to make sure that not only do we keep that average speed of answer at a acceptable level, and going into that, the difference between, really a public company and an organization like PSCU owned by credit unions, we anticipated the volume would grow, and I authorized at the very beginning the hiring of 200 additional contact center reps, just because it's the right thing to do for credit unions in managing that. That's a decision that I could make without worrying about what my quarterly number looked like to Wall Street. I could make that because it was, the right thing to do in holding up our business. Other things that we've certainly done, and, I think translates into what credit unions need to do as well, with that reduction in terms of wanting to use cash coming out of this, and even during, we've had a dramatic push on mobile wallet technology as well as contactless cards. In fact, we'll have over 3 million contactless cards on the street by the end of this year. And I would say, as you manage your card program, wanting to make sure that your offering is one that keeps top of wallet status, whether it's in the mobile wallet or in the plastic arena, that you've got contactless underway, and in terms of getting it at least to a natural reissuance cycle, perhaps even a mass reissue, just to let members know you're thinking about their sensitivity coming out of this, not only to cash, but to, even inserting their card into a merchant terminal with the EMV technology. In terms of everyday service and implementations, we've seen a 32% increase in the volume of our projects. So credit unions are not in a wait and see. Credit unions, at least, that we've worked with, have accelerated a lot of the projects and the work that they're doing in anticipation of reentry. So I think very prudent to go down that path. And then some of the things that we've done and enabled around skip a payment, rapid credit line increases, as well as alerts and controls on accounts to allow your members to manage their card programs in a more efficient manner, are things that we've enabled, no cost to credit unions. Just again, right thing to do in terms of positioning the card products, but also the right thing to do in terms of us enabling fast and quick turnaround to get that set up. Off of the PSCU homepage, we did put a microsite up, just not only that our credit unions could keep track of what we're doing, but also some pertinent information, just as we get various studies and maps from across the country as to how the pandemic is progressing. So all that's out there, and certainly invite you to utilize that. We've held one webinar at this point, another one forthcoming through our Advisors Plus group, and that deals a lot with positioning the card to top of wallet. That's where our spending trends right now, and that we're seeing pretty significant uptick in grocery and Costco-like purchases. Clearly, really bottom out on restaurant and luxury travel, that kind of thing. So making sure that you're recognizing where the member is spending, and positioning whether it's additional reward points or lower rate on those types of purchases to again help the member, I think are all things that will keep that loyalty high that you've worked so hard to establish over time. I think digital banking as we saw with some of those outages last week, we've always wondered what the balance is between a core decision, core processing decision, and a digital banking decision. And I would say, in talking not only to industry partners but to credit unions, it's kind of appearing as if a core processing decision is a 20-year decision versus digital banking and making sure that your digital offering, as a result of not only the trends that we're leading into the pandemic, but the acceleration that the pandemic is forcing, that really digital banking is a 5-year decision. That doesn't mean, converting every 5 years, but it does mean an evaluation to make sure that that digital offering is, as strong as competitors and meets the needs of members. When we start talking about reentry, one of the things that we've done in this scenario planning is really lay out 5 key areas that we're following, sustain lower cases of COVID-19, a period where, the fall continues, and Florida being where we have about half of our employees, that one's certainly one we pay attention to, but naturally, with 7 different locations across the country, we definitely pay attention to those as well. Hospitals fully functional and supplies restocked, wide-scale testing, shelter in place, and then a phased reentry for the workforce. So, nothing newsworthy out of that, but things that we're considering, and that type of guidance coming from the local government, that on a regular basis we're tracking. So, we've done some simple things that you may have seen coming through Facebook as recently as yesterday. We took a Seinfeld reference of square to spare, with toilet paper being a difficult thing to come by. We order in bulk for our buildings, so we just doubled the order. So we had a couple pallets of that, and we made available 6 rolls to every employee. They just, needed to drive by. We had tables set up in front of the office, and very secure, safe environment for them to pick that up. And small things like that, I think, really matter when employees are thinking about their company and the support they're receiving. So as we shift a bit towards cards, again, can't emphasize contactless and mobile wallets enough, that will definitely be the trend. And you saw commercials last year's Super Bowl with Saquon Barkley and a few others doing a contactless transaction. I think big acceleration out of this, and it is the time to get positioned around that. We're seeing ATM usage down right now about 36%. I've seen studies that show it as high as 50% when we get through this. PSCU does have a collections group of about 150 employees. Right now it's pretty quiet. Many credit unions called and asked us not to make calls right now, which is absolutely appropriate. But we're gearing to make sure we're positioned to support credit unions about a year from now, because who knows what that'll ultimately look like, and wanting to make sure that we're positioned not only to help the member, but to help the credit union as we come out. And then the other thing that we are certainly seeing is a spike in fraud attempts, not only fraud attempts at a cardholder level, but continued fraud attempts in the cyberspace, that those individuals not willing to take a pay cut are really thinking our eye, your eye are off the football right now, and that we're focused on dealing with pandemic, and what a great time to try and really hack in and gain access to data that can be used for keeping their pay up. They're not willing to take pay cuts. Additionally, we're seeing about a 32% reduction in credit card spend, again, following those same trend lines around grocery store, versus some of the other areas, travel and entertainment, luxury, and restaurants. We're seeing about a 12% reduction on the debit card side. Gas obviously remains soft because of less driving. Certainly the cost on that is obviously down. And then, as we look at online spending, we do think as you see the summer go on, that if schools are able to relaunch in the fall, that there will be a nice into the summer around clothing purchases and things to get set up for the school season. A bit of a guess around vacation season right now, but we'll continue monitoring to see what that looks like. In terms of overall fraud management at a credit union, one of the things that we're trying to do is really closely work with credit unions on seeing the trends in your channels, otherwise your branch, your call center, your digital banking applications, and be able to link those to the trends we're seeing in our call center and the day-to-day card spending, because the value of that information together positions us to be more proactive. We've invested in artificial intelligence as well as robotics to try and dig deeper and learn how we can best protect your assets, as well as keep the member confident in the credit union. It is the time to be thinking about reentry in my mind. Obviously, trying to ignore a bit, in all honesty, what's going on in various states with protests and all that. But in terms of managing our business and the whole local aspect to the credit union industry, I think is really a strong indicator of us being able to accelerate out of this. I think that's been one of the most prominent terms we've used, is how do we accelerate and ensure that credit unions are positioned to grow once the new normal ultimately materializes. So any support that we can provide on that, we'll do that. We have a significant set of data and a big data engine that we've invested in. So we're providing not only to the CU Times, CU Insights, CU Today, we're providing regular or weekly updates on spending, comparing it to last year, but also comparing it to this entire 6-week period that we've been in, so that you're informed. We can get that down to a credit union level so that you can see how you're syncing up not only with global PSCU data, but MasterCard Visa data as well, making the most informed decisions about the card portfolio, I think is prudent. And certainly you could see with the reductions that debit is certainly winning out at this stage, but the longer this goes on, it would appear credit would certainly get some transaction volume increases as well. With that, John, I think that gets me on that kind of 20-minute time allowance, and it covers not only from the pandemic and what we've been doing, but also a bit about the card side. And I know Norm will round out when he gets on a little bit later in the discussion.
Thank you, Chuck. I think it's interesting. One of your comments that you just ended with, I thought, is probably very analogous to what our credit unions are dealing with. When you talk about reentry and making sure that PSCU is there ready to help credit unions accelerate through this reentry period to grow, I think it's the same issue for credit unions. That's one of the questions we got, is as we start to come out of this, how will credit unions be positioned to make sure that they're helping their members grow, or be there for their membership to help them grow out of this? Since if it happens May 1st, somebody asked, if it happens May 1st, what do you think how do you think it would, how long would it take to get back to normal? So I don't know if you have a thought about that, but for the rest of our panelists to think about that. But that is a couple of questions about, once the economy does come out, how fast do we think it might take? And does that change depending on whether it is at school when we start to slowly come out of this, or whether it's, early in the summer?
So I guess my initial comment is it is somewhat a guess at this point, but I would say we're anticipating it lasting the balance of the summer, that we would see a continued reluctance to go to restaurants, full scale like it was before. And I guess somewhat it would be interesting to see what restaurants do to adjust, 6 foot spacing with tables and, all those types of things, bars, how they adjust. But at least on the transaction side, we are anticipating that to last for the better part of the summer. It also is something we're thinking about what vacation season would look like. If May 1 is that date and you have a vacation scheduled towards the end of June or whatever, is that a vacation that does happen? And I think it depends on the type of vacation. I think international travel will be the last to recover. So I think, with stimulus checks, with a big push for local and supporting, U.S. commerce, that I think there will be strong activity as we head towards through the summer around, those types of things. But, I would still suspect fall, and some of the stuff I've read, the data from the economist at MasterCard Visa kind of support that it would head here in third quarter, even into early fourth quarter, before we kind of see normalized purchasing. Now, certainly online will remain strong, but I think a lagged approach on some of those other items.
Great. Thanks, Chuck. We're going to move on to Andy, I'm sorry. If anyone has any other questions for Chuck, just feel free to send them through the question feature that we have out here. So what I wanted to do next is to introduce Andy Schaffel. Andy's the Director of the Board of Revenue Estimates for the Office of the Comptroller in Maryland. Andy's been very open and helpful along with the state, and presented to our credit unions in the past. So Andy, I'm going to go ahead and turn it over to you. If you want to go ahead and unmute. There you go. Andy, you there?
All right. Yep, I'm here. Can you hear me?
Yes.
Great. All right. Thanks, John, for having me. I appreciate the opportunity to talk with you all, and very much appreciated Chuck's comments. I think they dovetail perfectly with the conversations that I'm hearing when I talk to other industries, as well as the pure speculation that's sitting out there, and that speculation is key. So I am the Director of the Board of Revenue Estimates. I am housed in the Comptroller's office. I answer to the Governor, the General Assembly, and the Comptroller. So in that, my position is designed to fully remove politics from the economics and finance. So you don't have to worry about there being some sort of political spin in any of this. The state of Maryland's done a great job of ensuring that the politics don't penetrate the finances. Starting off, I kind of break down what we're facing into 3 distinct groupings. And the first is the immediate effects of the shutdown. We're all living that now. We can look out our window and see it. Just 5 minutes ago, my next door neighbor, they were visiting their grandson on the driveway and staying 6 feet apart, right? We're not out shopping. We're not out spending. Our friends are laid off. It's rough out there. Then as we re-enter, we start to contemplate, what does a recession look like? What is the shape is the common discussion now. Is it a U? Is it a V? Is it a W? Does it drag out for years? Do we get back to pre-recession norms? What are we looking at? So there's the bigger and longer question, which is the long-term direct economic effects of the recession. And then we have lasting effects. How is the consumer going to change? How are you as a credit union going to change the way that you do business? I thought the conversation about contactless cards, right? That's an immediate opportunity that makes a lot of sense. I was at the hardware store the other day. It was a small, very small store where I usually have to sign for every purchase I make. I don't have to sign there. There's going to be so many nuanced changes brought about by this entire COVID outbreak that could have real lasting implications for the economy. So let me jump right in and just say, so far, my thorough analysis has only focused on phase one, which is the shutdown. I tend to be a low risk individual is the prism that I tend to come from. And the state's fiscal year closes on June 30th. So here we are in mid-April, and we've got a couple months to go before we close out the fiscal year, and we have an extraordinary shutdown. So what we've put together so far is strictly the worst case scenario. The figures that we think that the policymakers have to be planning towards and hoping for better results. So that's what I'm going to present to you today and kind of talk about a few of the other items. But the first slide that's up on your screen right now is the revenue loss to the state's general fund. The general fund accounts for, as it sounds like, the majority of state government expenditures. State and local governments obviously do the most direct interaction between government and citizens as far as actually providing services. The general fund is critical to that. So the green line there is the total hit that we see in this sort of worst case scenario. That's $2.8 billion. That is 15% of the entire annual general fund. And in some of these months, such as May, where we'd expect to be seeing a fully phased in effect of the shutdown, in months like that, we're talking about a loss of 50% of the state's general fund revenues. The blue line, the rest of the lines are the components of that total. So the blue line, PIT, that's personal income tax. The bulk of that is withholding. One of the state's key revenue sources is withholding, which is, of course, the tax that we ask you as employers to withhold on behalf of your employees. That makes up 45% of the state's general fund, is that income tax withholding. So we are closely aligned to wages. Second is the sales tax. That is the orange line there, SUT, sales and use tax. Sales and use tax is 25% of the general fund. Making this seem even worse to the state in terms of taxable expenditures is that we tend to tax discretionary items as opposed to non-discretionary items. We don't tax food that you buy at the grocery store. We don't tax medicine. So a lot of the products that are in demand right now, we do not tax. I will say we do tax toilet paper. We don't have an additional tax on it. Maybe we should, but we do not tax toilet paper, or we do tax toilet paper. So we have that going for us. But other than that, the types of spending categories that are holding up or perhaps even increasing at this point in time do not tend to be part of the state's tax portfolio. And then we have myriad other taxes and fees, a lot of fees, and obviously we're not collecting any fees right now. Nothing is open. Nobody's going to court. There are no court fees. So we're talking about significant financial pressures. Unlike the federal government, we have to close with a balanced budget. So that is why we wanted to get these figures out here as well, is we wanted to we've got to find out how to deal with the potential of $2.8 billion less in cash. Some of it we can clearly punt into the next year and kind of kick that can down the road, and I'm sure we'll have to do that to some degree. But no matter what, we're going to end up paying for it. So that's really just pushing off the problem for a short period of time. But it's very likely that we're going to exhaust all of our reserve funds. The state is well positioned. We are a well fiscally managed state. We had about 7% of our revenues in reserve, in immediate reserve, so it's likely we'll get through that. We've also got a few other special accounts that tend to hold balances that we can tap into. But we are talking about a situation here that the magnitude of which the state has never had to encounter. During the Great Recession, that was spread out over the course of a couple of fiscal years, and we had time to react to it. It was very difficult to react to it, and we had to make very hard decisions, very hard cuts. But at the same time, it was spread out. This is hitting hard. I'm going to jump to the next slide, which we're all well aware of the unemployment figures, the claims at this point. But this chart, to me, really helps to illustrate how significant and unprecedented that these claims are. This is for Maryland. It's the cumulative initial claims. You can see there that through the fourth week, we're at 300,000 claims. Okay, put that in perspective. In Maryland, there's about 2.8 million jobs. So that would suggest that we've lost about 10% of our employment in 4 weeks. All right. Then you can see other recessions. In the early 2000s, the dot-com burst, followed by 9/11. We never hit that point. We got to a total of 116,000 unemployment claims. During the Great Recession, that is the red orangish line there, it took us 48 weeks, almost an entire year, to hit 300,000. And then during the early 90s recession, that one is 48 weeks. The Great Recession was 46. But you can see just the remarkable pace at which we're hitting these targets. And, while this stands out as a line on the chart, that is 300,000 households whose situation completely flipped upside down in the course of 4 weeks. Completely flipped upside down. If you spoke to anybody back in the middle of February, most folks thought we were going to have one more solid year of really strong economic growth, and then we'd start, sliding into that pending recession we've all been fearing for years. But no, 4 weeks later, 300,000 households out of work, and it's worth noting that those numbers are completely understated. The unemployment system runs on a mainframe. It was never designed to handle this kind of volume. So folks are having difficulties getting their UI processed. So we know that's understating factors. We know that the groups that have seen expanded UI offering due to the CARES Act are not counted yet. They can't even submit their applications at this point. That includes your independent contractors. Independent contractors are a big deal in Maryland. Independent contractors range from folks that do construction type work all the way up to the professional and technical services where much of the IT world lives. And the IT world is huge in Maryland. We certainly see a lot of independent contractors employed by larger contractors. So it's quite a good thing that it's been opened up to that group. That's a big deal for the state of Maryland. But the reality is, when you look at this, it's staggering. Everyone is very interested in what unemployment rate are we going to hit. I don't yet have a forecast for that. I'm certainly in the scenarios I'm playing with right now, I'm in that 15 to 20% range. But you can certainly see it maxing out above 25%. I will tell you that whatever gets reported will be understated. And that is because in order to be considered unemployed, you have to be actively trying to work. Nobody is actively trying to find a job right now, right? Companies aren't hiring. There is no orientation. It is going to be the case that the unemployment rate is going to look smaller as it gets reported. there are other measures of unemployment that could be helpful. So as you all try to assess where things stand, and your planning and whatnot, I'd encourage you to look at what's called the U6 rate. The U6 includes people that aren't looking. It includes people that are what we call underemployed, so maybe not getting the hours that they want, or not working at the type of job they think they're qualified for. So it is a much broader measure. So I would strongly encourage you to watch that factor as opposed to the one that will be reported more commonly in the media. So looking at where we see this impacting, I'm going to flip to the next slide. And I apologize for this detail, but I think this is something that could be helpful for those in the Maryland area. This is our withholding by NAICS code, so by industry, and this is what we've used to formulate our results. A bit of modeling and a bit of subjective analysis. As this is unprecedented, we don't have a lot of data to rely on to formulate projections. So we're having to put some pretty subjective parameters around our models and then see where they go. But we did a breakdown by industry for what we think we could lose in terms of withholding. And again, this is our worst case scenario. But you can see down there at NAICS code 72, which is accommodation and food services, your restaurants, your hotels, your casinos, down 90%. Staggering loss in wages there. And we are sheltered here in the state of Maryland. We see that we could actually see an increase in wages in government. Some of that coming from hazard pay. But there's a expectation that government will help to buffer us during this, and I fully subscribe to that. Government's a much larger share of our economy, both directly and indirectly, and government in times like this, typically, now this administration could be slightly different, but typically seeks to expand its economic footprint, as it should do, to stimulate the economy through debt. And that's what we're looking at now. And Maryland, we'll see a lot of those dollars drive through our organizations, one directly and two indirectly, as that money fawns out to the broader economy and the rest of the country. So while I'm looking at a 22% cut in our wage base, we're probably on the better positioned side here. Relative to just about any other state. We really, really are. So, we're thankful for that. Just to jump on sales tax real quick, I won't harp on this because I don't know that this directly affects you all, other than your volume, your transaction volume. This is our sales tax. And as you can see, the food and beverage category is the largest category of our sales tax. That's people going out to eat. That's typically a quarter of all of the sales tax that we collect. We see that collapsing by about 62%. Apparel, we've got that down 85%. Not a lot of clothes shopping going on right now. So while transactions are depressed, there's also the shifting of transactions within. So as you would typically see in any time of economic pressure, there's a transition from luxury goods to less expensive goods within the same category. But then, of course, you have the shifting in categories. So obviously, the food at restaurants is shifting to purchases at the grocery store. So a lot of changing habits immediately, but certainly more so in the long-term outlook. So I'll shift now to kind of the recession issues. Acknowledging that, again, I don't have an official forecast yet. We're working on that. I think in the next week or two, we'll be coming out with something. But what we're talking about is a huge range in scenarios. And that gets back to what I think is going to drive this recession deeper than what some are thinking, and that is just the absolute magnitude of the uncertainty out there. Chuck was talking about what is the timeline for the stay-at-home order. Well, I think most people are thinking this extends into the summer. There's the possibility that as we ease restrictions, we see another outbreak. What happens then? Do we go into another shut-in the fall? Certainly a very possible scenario. There's indications of that happening in the Asian countries now, where they loosened restrictions, and surprise, surprise, now you're seeing another upturn in outbreaks. Well, what's the government's response going to be to that? And we don't know how the Asian countries are going to handle that, but we certainly don't know how we'd handle it if we're presented with that impact. But it's not just the uncertainty of how this outbreak is going to play out, but it's the uncertainty of how our economy is going to change. I personally held back my office from more teleworking before all of this. We had our staff, we would alternate Fridays, and occasionally do a little more than that during slower times of the year. But I tended to still, government's a little slower, and we don't have all the capabilities that the private sector does. So person-to-person interaction is often how some more communication occurs. I get that, but the reality is, after this, my shop will probably work remotely. We won't need an office, and I know I'm not the only one thinking like that. What does that do to office space? Office space was already under siege throughout this entire prior economic expansion. You talk to any commercial real estate owner, and they were still adapting to remote work. Now we're going to be speeding that up. There's going to be some real interesting changes in consumer behavior, but uncertainty reduces hiring and it reduces investment, and these things are circular. So as we reduce hiring and reduce investment, right, our suppliers are affected by that. And I think we could really be creating the fundamentals that could lead this into a pretty prolonged recession once reentry occurs. So I think we are talking about a pretty dangerous situation going forward. But uncertainty extends beyond the investment and hiring decisions to these scenarios. I am often tasked with coming up with one figure because we have to tie it to a budget. We're going to present scenarios, and I'll tell you, never have my scenarios ranged more broadly than they do now. I mean, we're talking magnitudes in the range from our average scenario that are 10 to 15% deeper than what we're seeing as our baseline scenario. I've never had that kind of uncertainty in my forecast. So we're in unprecedented areas. We have to struggle with inflation and deflation. Key for you all, I'm sure, is interest rates. We know where the Fed funds rate is now at 0. It's going to be there for quite some time. We know that the supply chains are deeply impacted just from when their shut-ins were occurring months ago. And typically that would create inflationary pressures. When a supply chain is disrupted and there's less of something, businesses will bid up the prices. However, at this very moment, right, we have tremendous decrease in demand, a decrease in demand that is certainly outweighing the decrease in supply. And so in the near term, we're facing the likelihood of deflationary prices as businesses do everything they can to encourage consumers to spend as much as they possibly will. So I think in the near term here, we're seeing some deflationary pressures. In the intermediate time, it's likely we're going to see some inflation pressures. And then once we get into, once we're reopening and walking back out into the economy, what's it going to look like with all of the federal borrowing that's taking place? I think that federal borrowing is necessary in the near term, but we're talking about once all is said and done at the federal level, which is going to be another bill or two, probably $4.5 to $5 trillion. $4.5 to $5 trillion. It's almost a third of our entire economic output. You know, you can't really print that much money and not see inflation. Now, we all said that during the Great Recession as well. I think there was an expectation that there would be some pretty strong inflation following the fiscal stimulus during the Great Recession, and that never did materialize. So it is possible that the global connectivity of our economy is changing the way that our money inventory affects inflation. That's possible, but it really seems difficult to imagine that this $4.5 to $5 trillion doesn't trigger a higher inflation environment in the future, and likely higher interest rates as well, as it crowds out other forms of investment. So that's really the bigger macro issue that concerns me. Looking out over the course of the next 2 to 5 years is what is that going to look like? Where are we going to be with interest rates and inflation? And I do think we start to see the higher rates and the higher rate of inflation going forward. So, I think that's something that businesses should be preparing themselves for, is an environment that looks quite different than it did from this most recent economic expansion. So I'm sorry I don't have more to share with you at this point in time, but I think it would be disingenuous to pretend that I did. And I think it's responsible for all of us to acknowledge how uncertain our outlooks are at this point in time, and not to try to pretend like we have all the answers until we start to see some real results, which I think is going to be months out. So with that, I'll conclude my presentation and open it up to questions.
Andy, thanks so much. We do have a question. Question is, what is the likelihood the Fed will have 20 to 50 bonds to lock in debt at this historic low rate?
I'm sorry, could you repeat the question? 20 to 50
year bonds. What's the likelihood the Fed will have 20 to 50-year bonds to lock in debt at the historic low rate?
Oh, I don't know. I don't know where the Fed will head with that. I think that's an interesting proposition. I was actually encouraging the state to do that about 5 months ago. We do 15-year debt, but it made sense to lock in these low rates. I don't know, but the Fed is doing a phenomenal job. I will say that. I think they are exploring areas, to your point, 50-year debt, items that they've never considered before. And they're doing a really good job of holding this recession's risk to the financial markets to date. Obviously, we'll have to see if they can sustain that as we hit new phases of this downturn. But so far, the Fed seems to really be on top of things.
Great, thanks, Andy. Thanks so much. I appreciate your time and for joining us today and for the information. It's definitely an interesting time, I think, for probably that you all are going through, being so unprecedented. When I looked at your graph, I always think about the fact that we thought we wouldn't see another great recession, and here we are, just over 10 years later, hit even with more uncertainty and uncharted waters. Going on to, so thanks again, Andy, appreciate it.
Sure thing, thank you all.
Next up is, we're gonna start with John Cutchy. John is the Regional Director for Region 2. And John, or for Eastern Region, sorry, no longer Region 2, for the Eastern Region, sorry, John.
That's right.
But I did, we'll turn it over to John. And John, just a caution, if I do get a call from Congressman Brown, I may have to jump in. So just
Understood.
to warn you. Thanks.
Sure, no problem. So good morning, everybody. I'm going to provide a couple pieces of information that has changed since the last call a couple weeks ago, just to kind of keep the information fresh. So I guess I'll start the question that was asked during the first survey. During the first presenter dealt with what's the future look like? What does it look like coming out of this? And, you know, one of the things I said to my staff when this whole remote posture started back in the middle of March is, throughout this, we're going to find things, nuggets of value that will actually make us better in the long run. And I think that's already happening. And the presentation on touchless credit and debit cards is a perfect example of that. That's something that, regardless of whether there's a COVID-19 pandemic going on, it just makes good sense, and it's something that should become mainstream. I think you're going to see restaurants continue some of the practices they put in place to survive during this period with curbside delivery. Because I also agree with the comment that people aren't just going to start automatically going back into their normal way of life. Whether Congress, the White House, the state declares something over, it's not over until people believe it's over. So it doesn't matter what you say publicly. I mean, that will have an impact. I mean, it's going to open up some of the activity and the flow, but the reality is people are still going to be kind of skittish for a while of just open public places, shoulder to shoulder activity like we are used to experiencing. So I think you'll see a combination of things going forward. Restaurants and entertainment industry adapting, social distancing staying in place. So there's ways to do both. There's ways to interact, and there's ways to also be smart and protect yourself. And I think the same thing applies for credit unions. Some of the things that you've put into place, dealing with employees working remotely, teleworking options. I think one of the things that I've heard regularly is all kinds of businesses, credit unions, the NCUA, public and private firms have realized that they can actually be extremely productive without being in a physical location, sitting in a cubicle next to another person or in an office next to another person. So I think you're going to see some interesting developments that combine the best of what we've learned with getting back to quote unquote normalcy. So that's just one of the pieces that I wanted to chime in on that was discussed earlier. In terms of NCUA, where if you've heard me in some of the earlier discussions, we're really still looking at two primary areas with credit unions in terms of safety and soundness. One is the liquidity position, and the other is the impact on loan losses, credit risk, if you will. On the liquidity side, things seem to be pretty stable at this point. The outflow that we saw during the first few weeks of the pandemic period seems to have subsided. People seem to be more comfortable with the new normal, which is what we would have hoped to have seen. But we still put into place various backstops to help credit unions out if they run into liquidity situations. And the things that we see more on the liquidity side area now in terms of risk relate more towards the types of forbearance programs that credit unions may have entered into for the different loan products. So where you're normally used to a certain level of cash flow coming in, you may not be receiving that level of cash now for payments on loans. And in some cases on the servicing side, loan servicing side, such as mortgage loans, there's contractual responsibility to still remit those payments. So there's same level of outflow, but lower level of inflow. So management, credit unions should be modeling a little bit of this and anticipating what this is going to look like over the next month, 3 months, 6-month period, depending on how long this all lasts. So that's the liquidity area. So again, mostly good news there. I think that things are in a really good spot. Credit risk is the next thing that we're really spending a lot of time on at the agency trying to model at this point, because a lot of unknowns. Unemployment, as was mentioned, is it shockingly rising levels, depending on how much longer this remote posture goes. It could continue to rise. There, as indicated earlier, unreported levels of unemployment. So this is like something we've really never seen before, and it's nationwide. So we're trying to model various scenarios and identify credit unions that could really be under a lot more stress as we go forward for the next several months, which means some phone calls and contacts from your examiner potentially. This is all incredibly preliminary. We're just in the discussion phases at this point, so there is nothing coming in the near term in terms of formal contacts in this area, but we want to let you know this is something we're spending a great deal of time on at the agency, trying to model and trying to come up with answers on how we can best help credit unions through this period of time.
Hey, John.
Yes.
Yeah, sorry to interrupt you. We have Congressman Brown on the phone right now, so we'd like to kind of let him jump in and say a few words of that. So, Congressman Brown, thank you very much for joining us. Just wanted to introduce you to the group, and if you would be kind enough to just kind of give us your perspective and thoughts on where we're at and kind of going forward, possibly with what is going on down on the Hill.
Sure. Thank you very much for having me on, and I want to thank you and your member institutions for what you do to support the community, small businesses, individuals, making sure they have essentially the cash that they need to keep their doors open and to take care of their families. So what I thought I would do briefly is just, real quick, where I think we are right now with the next action that Congress will take, highlight some of the requests that I am putting into my list of requests that will go to leadership for the larger next package, which is not necessarily the next package, and then related to that, some of the letters, at least 2 of them that I've signed on to that are of interest to the credit union community. So first off, let me say that we are nearing agreement with the Senate. It's the House and the Senate, it's Democrats and Republicans, it's Congress and the administration, getting everybody in alignment so that we can pass the next round of relief. What I believe will be in the next round of relief will be at least 250, if not more, $billion for the Small Business Administration loan program, combination of the Paycheck Protection Program and also the emergency loan program, and a big emphasis for Democrats, frankly, has been to be able to get those funds, funds to the institutions, the lending institutions that are more likely to lend to truly small businesses. There are too many stories of larger corporations that have consumed a great deal of that first tranche of SBA loans, and we want to make sure that you have truly small, if not micro, businesses who are able to access those. That'll be in there. The big holdup was how much we were going to provide for hospitals. Many of us believe that now was the time to provide greater funding for hospitals, other health providers, community health centers, etc. So we were able to, right now, I think we're closing in at about $100 billion, $75 billion for to the providers, $25 billion for testing. If we have any hope of opening our economy anytime soon, you cannot do that according to the public health officials. Most governors understand this. You cannot do that without national rapid testing, a robust and accurate contact tracing, so that you can do the necessary quarantines if and when you see that you may have a problem in that particular a community that is undergoing sort of like that opening. So where money is in there as well. So I think we're reaching agreement. We should be reaching an agreement soon. The House was notified yesterday that we should be ready to be in by Thursday morning. And the hope would be that that the Senate can act on it this afternoon, and then it'll come over to the House. Unfortunately, we'll have to go to the floor to vote. Many of us would have liked to have been able to do this on unanimous consent, but there are some members that want the voice vote, so that will happen, and it is likely to happen on Thursday. Some of the items that I'm advocating for, and this is based on the engagement that my office has had with the Credit Union National Association, with the Maryland Association of Credit Unions, and a number of other organizations. And one is, of course, additional funding for SBA's Paycheck Protection Program, increasing access to lending for our nation's small businesses by amending the Federal Credit Union Act to provide credit unions greater relief and flexibility from the member business loans cap. I've signed on to a letter in that regard. Also, I'll be promoting we ensure that the Treasury and the SBA have the tools and resources to properly administer the SBA PPP and inform lenders how to use the program. We had some difficulty with that coming out of the gate a few weeks ago. Also, I'll be promoting the provision providing the National Credit Union Administration with the same powers as the Federal Deposit Insurance Corporation, extending their ability to establish a maximum guarantee to all shares or deposits held in the federally insured credit union. I also believe that Congress should amend the Federal Credit Union Act to allow all credit unions to add underserved areas to their field of membership, and also provide capital relief to credit unions by not subjecting them to the current expected credit loss standard. And I believe I've signed on to a letter in that regard. So, that's sort of like the next round of relief. Then we're going to have the larger CARES package, where I think many of the items that are important to you, if they don't make it in this very next round, should make it in the following round. And of course, I'll end on the note that we have to make sure that we are supporting state and local governments. They do not have the ability to go into annual deficit spending like the federal government does. They provide essential services, and many of them, most all of them, state and local government have seen declining revenues and are on the verge of curtailing, cutting back, eliminating essential public services. So we've got to make sure that this is a comprehensive approach to supporting various sectors, public and private. So with that, let me stop there. I'll be happy to try to field whatever questions I can, and perhaps even more importantly, I'd love to hear what the concerns are, the considerations of the members, and how I can be helpful.
Congressman Brown, first of all, I just wanted to say thank you, and also I'd be remiss if I didn't thank you for always having an open door and phone. I remember back even during the shutdown when you were kind enough to invite us to talk about all the things credit unions were doing in your district to help out folks that were affected by that, and how proactive you were. So I just wanted to thank you again for being here, and for being there at times when we needed it. So thank you very much. One thing that one of the questions that came up was, how long do you have a feel? Obviously, there's no playbook for this, but an idea or thought is to, if May 1st were a date, hypothetically, that we could start to look at the economy coming back, any feel for how long you might think it might take for the economy or the public to kind of get back to some semblance of normal?
Sure. First of all, I think we have to accept the fact that normal, as we understood it, let's say on February 1st of this year, is probably a long ways away. And some may surmise that we'll never really get back to that normal to the extent that this pandemic has altered, modified the way that we've interacted with each other socially, economically, and in so many ways. And I think that just as when we came out of 9/11, we had a heightened sense of physical security, and you saw more businesses investing in the security aspects of ensuring and securing their business. I think coming out of this, we will see a similar sort of investment by businesses, not so much in security, but in remote and distance engagement, interactions, learning, transactions. I think a company, a year from now who's looking at lease renewal, and they may have needed 250,000 square feet, may very well say to themselves, hey, you know what, based on the experience that we just went through, our ability to transact and engage remotely, we're probably going to look for 150,000 square feet. And that additional savings will enable us to invest in even better remote engagement, whether it's hardware, software, training, giving employees tools that they can use at home. So I think we're going to see that. I think schools are going to rely more on it. I think it's unfortunately, I think it's going to have a long-term impact on our travel industry. I think in terms of business, I think many businesses will realize that, hey, we can actually get things done remotely, so we don't need to necessarily put someone on a plane to drive to fly to Cincinnati, to fly to California, etc. So whatever that normal is going to be, it won't look like what it did on February 1st of this year. But I think really your question is really more about, hey, what is my sense? When do I think we're going to get back to some sense of regular interaction, more face-to-face, folks out there spending money, recharging the economy? You put out the May 1st date. I think that it's closer to the end of June. Just based on my lay understanding, listening to and trying to understand as completely what our public health officials are saying, looking at what our governors, who they're listening to, the manner in which they close their economies, and what they're saying about opening their economies and the criteria they're going to use. I think that June, at the end of June, is when we're going to see. No sooner than are we going to see some opening, and the big issue there, obviously, in the absence of a vaccination, and given the efficiency, if you will, of this virus, it's very efficient in the way it transmits itself, the way that it can kind of survive, unlike many viruses in the past. In the absence of a vaccine, social distancing continues to be our best medicine. We are in many places around this country. We are in surge. We're in surges. What may very well be a peak, but I think most people understand, or should, that this is the first wave. And until you defeat the virus, you will have subsequent waves. And so absent of vaccination, it's social distancing. And in order to figure out what is the appropriate level of social distancing, can we relax it a little bit, open up our economy, open up the community a little bit more, you have to have national rapid testing. You have to have rapid testing, and then the ability to do that contact tracing, so that when you identify an issue in that community, in that customer, at that credit union, hey, who did they touch? Figuratively, if not literally, who did they touch? Where have they been? Who do we need to isolate? Can we do it in a way where that credit union can keep its doors open? Your customers can continue to come in because we have a high degree of confidence that we know exactly where the issue is. And until we get there, we will run the risk of a second wave, third wave, et cetera. So that's a long-winded, and that's why since day one, many of us in Congress have been saying testing, testing, testing. So that's a long-winded way of saying I don't think it's May 1st. I think it's more like July 1st, and maybe it'll be somewhere in between.
Great, thank you. Another question that came up, and I think this is probably one of those unintended consequences of one of the rules, but just wanted to share with you, one of our credit unions, it works with a childcare business, and the orders, for instance, here in Maryland, is that the government will provide funding should they remain open as a childcare business to first responders. The funding has not occurred, and the Maryland orders preclude the business from accepting direct payment from the first responders. But unfortunately, the child care facility now is going to have to close because they have no funding and no payments coming through as promised by Maryland officials. Is there anything that you would recommend to them or anything that they could do to try to remedy the situation?
So a few things. One is, thanks for bringing that to my attention. Hunter, who's on the call from my staff, participates in a weekly call with the governor's staff, the Maryland federal delegation, and a number of other people where they, basically talk through these issues. So number one, thanks for putting it on our radar. The other piece that we should look at is in Maryland, and let me see, I don't have the precise name of the program, but Maryland, and Hunter, jump in if you, this is what Senator Rosapep sent me yesterday, Hunter. Maryland has and about 20 plus other states have the program, and the unemployment insurance program, where you can actually have employees work and also receive unemployment insurance compensation. Now, that would not help the daycare provider with all of their costs, but it certainly is an opportunity where they could bring in employees under certain conditions, limitations on hours, I believe, and those employees would be compensated not by the daycare provider or that first responder, but through unemployment insurance compensation. So now that's sort of, I'm not 100% that that's available in this scenario, but that's what comes to mind as you raise this issue. So we'll chase that down. We'll run that down, and we'll get back to you and see whether that's something available. But whether it is or is not, we'll raise that with the governor to see if he can provide some relief by modifying his emergency order, his emergency declaration, so that first responders or some other source of funding to keep those daycare facilities open for children of first responders.
Thank you very much. I appreciate the help. That right now, I think that's all the questions we have right now for you. Just want to say again, thank you very much for taking time. I know how busy things are and everything's a moving target, it seems like right now, for what we're going through.
Well, look, John, I appreciate the Maryland DC Credit Union Association and its members. Appreciate the working relationship that we have on Capitol Hill as well as in the community. And my staff and I will always be available to you. However we can be of assistance, please don't hesitate to reach out to us.
Thank you, and appreciate all of your support.
Okay, have a great day.
You too. Thank you.
Bye.
Thanks everybody for bearing with us, and John, thank you for letting me interrupt you. We'll go back. I'll get you back to your slides now. So, okay, John, you ready?
Appreciate that. So, I guess so I talked a little bit about liquidity, talked a little bit about forward-looking supervision. We are, just to pick up on that point, I mentioned that we're spending a lot of time modeling credit risk right now. But that modeling is going to help feed which credit unions we visit initially once we're back to on-site contacts. We're trying to figure out what the resource hours are going to be for that, which is important for the credit unions on the phone because it's going to have potentially a material impact on what our exam program looks like the rest of this year and quite frankly, 2021, depending on how bad the economy actually turns out to be. So I just want to let you guys know that right now that our exam and supervision program is in flux, and we're working on what those future pieces are going to look like and what the new, at least near-term steady state is going to be. In terms of the central liquidity facility, if you keep up with the NCUA news, the board has approved the implementation, I think, interim final rules related to managing the congressionally approved changes to the central liquidity facility, which in a nutshell gives you, the credit unions, more options for funding your liquidity needs as you go forward. Some of the barriers to entry to the lending and mandatory wait periods and things like that were all streamlined and in many cases eliminated, so you can get pretty quick service and cash from the CLF if necessary. The other thing that we're still reviewing and putting rules in place around are the PPP loans. If you're keeping up with all of that, you may have seen that the funding, the $350 billion that was set aside for small businesses, was absorbed in less than 2 weeks. So Congress is now negotiating over another large chunk of dollars for the small businesses around the country. So if you didn't get into the first wave and you want to get into the second wave, you still may get a chance. We know a lot of credit unions got locked out because the SBA just was not equipped and structured to handle the kind of activity that was coming through. So what we were kind of seeing, if you were not already an SBA approved lender and you were trying to get approved, you could have been on wait or lockdown, not intentionally, but just the systems were not geared to get everybody in who wanted to participate. So stay tuned, there may be more there. We are planning, as I've heard, potential changes to the call report, and that would be for probably the June cycle. That may try to gather some information on the PPP programs that the credit unions are participating in. There's also some discussion going on forbearance programs and things too, so that we can kind of track some of the progress of credit unions and identify potential areas of concern as well, or I should say challenges, not areas of concern, challenges for credit unions in managing those programs, because so many of them were put into place so quickly. And I know you were doing what was necessary to take care of your members, and that's what NCUA has actually recommended as well. But we want to make sure that your operating performance is something that can be sustained going forward, and if you need help from us, we can give you that help. So those are some of the things going on there in the PPP program. So those were really, John, my main things I wanted to bring up that sort of have developed since the last town hall that you did, and I'm open for any questions you guys might have.
Thanks, John. One of the questions that we did have, and you touched on the PPP, but I know that the agency has had some guidance about the increased grant funding for loan-designated credit unions. Who should we direct, just to let credit unions know, who should they contact directly for more information on that? What's the best area?
It's the Office of Credit Union Resource and Expansion. So the CURE office is the arm of NCUA that deals with that. And I'm pulling up the website now because I'm pretty sure you can go straight to get that information.
Yeah, I think the online
the application process is online.
Yeah. Great. John, as always, thank you very much for your time and for always being available. I know you guys are, like everyone, are just busy trying to adjust to all of the newness that we're dealing with, especially from the way you all have to supervise. So thanks again.
Yeah, actually, John, I did while we're chatting, I did go to ncua.gov, and in the search criteria, I just typed in grant program, and it took me to a page that has a link to the application guidelines for the COVID-19 emergency grant fund. So it's pretty easy to find.
Great. Thanks so much, John.
Sure.
Appreciate all that. One question that just came in was, are there any updates regarding the advance notice or proposed rule for secondary capital?
Nothing that I'm aware of. I know the board is considering a bunch of regulatory relief alternatives, but to be honest with you, a lot of the normal regulatory business is on hold so that the focus can be on COVID-19, because the relief efforts for credit unions is front and center. There's still several other rules and changes that are being considered by the board in relation to that. So I believe that that's the priority right now. So normal rulemaking has taken a bit of a backseat.
Okay. Great. Well, thank you, John. I appreciate it.
My pleasure.
Next up, we're going to go and want to thank Commissioner Salazar for joining us once again. I'm sure he's getting tired of hearing my voice, I know, with all the different calls we've had and discussions. So I'll turn it over to Commissioner Salazar.
John, good morning. Can you hear me?
Yes. Good morning. Thank you.
Great. Thank you. Hey, no problem. During this time when uncertainty is so high, I think it's important that, communication be at the top of the list. So I really appreciate the opportunity to talk with you and, contact through you to your members. For example, one of the issues that came up recently was the question of the applicability of the mask guidance that came out from the governor on Saturday. And many of you probably had some questions. John, and our office worked together to get a clarification from the governor's office on that when the rule was written, it was really directed towards retail operations that were open, grocery stores and the such that still had people coming in, and that it wasn't necessarily directed towards financial institutions like banks and credit unions who, might be considered retail, but not for that mask ordinance, because there was an understanding that they had some unique security concerns. So, I was able to pass that information on to John for the members. And, with that said, of course, obviously we and I encourage everybody to wear masks and make sure that consistent with your security obligations and concerns that you do so and follow the CDC guidelines on the social distancing. I've got a couple of things to talk about. Let me just start out one point that I heard early on was, some talk for comments maybe about the status and the, future as to what we see. So I can just give you a real 30-second review here. From my perspective is that, number one, I personally, and I know a lot of people do, have great faith in the governor's approach right now, because he's, following the science. He has a lot of good people surrounding him, and they're taking a measured approach to getting the state back into operation. And the comment is, and the emphasis is on preserving life and making sure people are safe. So that's one of the guiding principles. I think in Maryland we'll probably see a slower rollout and a cautious steps by the governor, but he said they'll talk this week, so we look forward to hearing from him on that. The good news that I see is that as we went into this, Maryland, as Andrew pointed out, was in a good position. We do not have, as some other states do, a lot of at-risk industries, because we're supported by education, government employment and things like that. So that's going to help people here in the state of Maryland. Number two, I think, as in contrary to 2008, trust in the banking institutions is higher than it was. So, people are seeing, particularly on the credit union side, the institutions stepping up, working to help not only the members, but the citizens. Number three, I think, the institutions here in Maryland, they're all strong, and the leadership has proven that, they've been forward looking and can structure and guide their institutions through, what is proving to be quite uncertain and tough times. So I think, all that sets us up for, not an easy path, but a good path. I'm confident the state of Maryland and our folks here will get through. I encourage, just as John said, that they were working on modeling and looking ahead. I strongly encourage all the institutions here to do the same thing with their portfolios to the extent, you can. Obviously, you've got to have various scenarios, and our office is always willing and able to talk with management. We've been doing it with our institutions on what their plans are, what they're thinking, maybe what we're hearing from state government. If we can help out with that, feel free to give our office a call. We can work with our examiners and with our senior staff to help out. On just a couple of specific items, the CARES payments, questions have come up about those, and those are exempt from most federal government set-offs other than child support. There's a question, and I would ask that institutions, I know many are doing it, I would ask all to forbear from exercising their own set-off against those funds so that they can be used by the members who need them. With respect to the PPP program, I was really pleased to see that a lot of institutions jumped into that. I know it was rushed and it was complicated, but people made the best they could. As the congressman suggested, sounds like we'll get an update for that, and hopefully that phase 2 will be a little better structured and maybe a little easier to use now that some of the documentation and standards have been set upon. And last but not least, I really do want to say thank you and express my appreciation to all the institutions out there, because I've seen that they are, using forbearances, they're using fee waivers. Some are actually making grants, not only to working with their members, but they have reached out to the greater community, and that really speaks volumes and very well about, the credit unions that are working so hard in our state. And I just want to recognize that and, express my appreciation and our office's appreciation for that. So with that, John, I can answer any questions.
All right. I don't have any questions specifically, Tony. I think you answered most of those as we've been going through. So thank you very much.
Thank you.
All right. Next up, we have Norm Patrick from PSCU, their advisors consulting area. So Norm, are you there?
Yes, I'm here. Can you hear me, John?
Yes, I can.
Okay, great. Well, good morning, everybody. Glad to be on the horn with you this morning. Just a couple of slides that I wanted to run through with you today regarding some of the insights. So a little bit of softening, happy there. Same thing going on with credit card balances, about 3.45% lift year over year on balances. Looking at credit card charge-offs on the right-hand side, we had a nice trend starting to form, not so nice trend, around a slight increase on the credit card charge-offs. When you look at all federally insured credit unions, we're at about 3.3% ending 2019. Excluding Navy Federal, which obviously is a huge chunk, that takes us down to about 2.76. Still performing about 50 basis points better than the top 100 banks altogether. Okay, to the next slide, please. Okay, recent consumer spend trends. What we're looking at here is year-over-year growth over the past 8 weeks. And we're comparing the same week year-over-year. So this week is week 14 compared to the same week of last year. And as you can see in green, our PSCU overall results, as Chuck mentioned earlier, we were at about 31% down year-over-year. Been a pretty consistent trend here over the past 3 weeks. And when we look at DC and Maryland Credit Union specifically, a much wider clip there, about a 15 percentage point difference. And it's really driven by a lot more travel and transport volume that we're seeing in those particular markets. And then looking at the right-hand side, this is our debit dollar growth rate. And we've actually seen a little bit of rebound in debit over the past couple of weeks, which has been nice to see. Not a big gap geographically when comparing the U.S. to the D.C. Maryland markets. But our big wild card that we see coming up for this week, looking forward, is that Easter week, which happened in the past for us this year. Easter week in 2019 actually happened in the week that's coming up. So we're probably going to see some type of magnification in the delta year over year as we look to the next week.
Norm, are you there? Norm?
Okay, I'm here. Sorry about that. As you can see here on this slide, this is credit card spend by category over the past several weeks. And if you look categorically from left to right, you can see which sectors boomed and which did not do so well. Probably our strongest over the past couple of weeks has been in the retail titans, which for referring to your larger retail players where the cardholder interacted digitally, by purchasing online. And this is also going to include Amazon volume and things like that. So the performance continues very well there. The grocery sector, you can see the stock up sections there for about 3 or 4 weeks ago, where people tended to stock up and hoarding the toilet paper and everything else in the world. And since then, we've kind of dropped back to more of a more reasonable growth rate. And as you look all the way over to the far right-hand side, you can see where we were hit in particular, all the way from services to retail, brick and mortar, gas, food and drink, entertainment, travel and transport. In fact, we saw airline spending down about 95% in the Maryland, D.C. Markets over the past 2 weeks. Okay, to the next slide. This is a similar view for debit card volume. The big winner here is money services. If you might ask, what's a money service? This is going to be, your Venmos and your PayPals of the world, where people are moving money virtually through the card rails. And very interesting there, the first couple of weeks, we were up over 100% growth in money services volume that ran through the debit card rails. And that has subsided a little bit. But I think that kind of attests to the fact that people really aren't interested in touching paper currency or getting within 6 feet of people to hand it to them. So it's been a big boon on the debit card business recently. Also, digital spending, the grocery sectors, all that, as we saw on the credit card side, we're pretty big with debit as well. And then on the right-hand side, pretty much the same sectors, taking a hit over there. We see travel and transport with less of a hit because there's really not a lot of hotel or car rental type of transactions that take place on debit because the holds that end up going onto the checking account.
Okay.
Next slide, please. All right. Well, let's continue the somber note, but we will have a glimmer of hope here. 3 tough things that will affect card payments overall in 2020. And again, this is all prefaced by what we know now. One, year-over-year sales volume, we are going to see impairment going through, I say at least the summer, potentially into the fall, but it's ultimately going to depend on when things are opened up and when people are at the level of comfort to be out there using their payment cards again. So next thing here, revenue is going to take a hit. I think this is going to happen on various levels within the card programs. Loan growth will be depressed as consumers and issuers both get a little more concerned about the extension of credit and the management of credit and all that. Although there may be some offsetting growth that happens due to people being out of work and relying on their credit cards to get by in the meantime. Margin compression, obviously, with the emergency rate cuts and the catch-up time we need on the deposits to catch up, so we'll have some margin squeeze. And as I mentioned earlier, with the sales volume coming down, interchange is going to suffer as well. And based on that, then the mix of transactions that are going on, there should be some pretty significant compression happening there. And the big reality, as we see the unemployment numbers and all that, credit card losses are going to increase over time. It's been a big chain reaction that we've gone through, and ultimately, coupled with low savings rates, we are going to see losses. Okay, and I think to the last slide, just a couple of parting comments I wanted to make about underwriting. And I think, upon reentry, as we talked earlier, we are going to reenter, and there is going to be a bright future someday, and we are going to press the accelerator. But the operating rules are going to be a little bit different. And I think with the abruptness as the situation has come upon us, it's really been a shock through the system. And I think it's really going to challenge our current credit evaluation methods as it pertains to credit card. So I think looking at a customer's or a consumer's credit score in itself isn't really going to tell an accurate or true story in a lot of cases, given that we've pushed payment deferrals down the road, skip a pay type of programs and all that. So when the delinquency actually materializes and hits the charge-off line, we could be several months down the road. So we will have a lag here. So in the short term, I probably would suggest, taking a look at trade lines on credit bureaus versus relying on the scores alone to get that full picture of what's happening with all of their trade lines. Consider the total relationship the member has with the credit union. For new members, I probably would look at doing a little more income verification versus using the inferred income that the credit bureaus are providing. And then when it comes to credit card line assignments, you may want to dial it back a little bit at the beginning, let them prove themselves out that they're able to provide consistent payment and show great behavior, and that's not going to do anything to limit you in providing credit line increases as you get down the road. So I think the message here is we continue forward. It's a much different environment. We're going to need to get a little more conservative about how we manage the credit card programs, but I think we should continue to invest, but we may just invest those marketing dollars a little bit differently as we move forward. I'd be happy to take any questions, John.
Thanks, Norm. I appreciate it. And I don't know why, but it really stuck out when you were talking about with Maryland that air travel, or what you saw with air travel, is down 95%. Kind of dovetails back to what Chuck was saying. Is it just reminded me of how it's going to be, different sectors are going to have different recoveries depending on what's going on. And even within those sectors, domestic travel might be much different than international travel, or if people are going to get on planes. So, right.
There surely is a lot to be seen.
Great information, though. Thank you so much. Don't have any other questions right now, Norm, but thank you very much. Appreciate it. Thanks for taking your time today with us. And just to let everybody know, we will have the slides available after, along with contact information will also be at the end. So if you wanted to reach out to anyone or reach out to Norm directly. All right, so going on to, as we like to affectionately say this time of the year, betting cleanup, and taking it home for us is John Bredehoft from Kaufman and Knowles. John, are you ready?
Yes, indeed, John. Thanks for having me.
Sure.
I'm going to really limit myself to what has happened in the past 8 days or so. We do have some more guidance from the federal government on all these employment law and human resources things. And there are a couple of particular points I want to make. But just to give context to that, and if you've been at one of these virtual town meetings before, you've seen all this. Emergency paid sick leave is one of the two new types. It applies to all employers with fewer than 200 employees. It's a benefit for 2 weeks of leave, and you get a tax credit. We're going to talk about that in a bit more detail in a moment, because that is one of the new things that happened. If we go to the next slide, you can see the different categories of emergency paid sick leave. You can get it under one of the first 3 categories if the employee themselves is the affected individual. The employee is subject to a quarantine order, the employee has been advised to quarantine, the employee is sick and actively seeking a diagnosis. If the employee is out for one of those first 3 categories, they get paid at full pay, and you pay them, although that's subject to a tax credit. The other categories, mostly 4 and 5, because we don't have anything under 6 yet, if the employee is caring for someone who's under quarantine or isolated by a doctor, or if they're caring for a minor son or daughter who's at home due to school or daycare closure due to COVID-19, they get paid 2/3 of their usual salary, subject to a daily cap of $200. So that's emergency paid sick leave. Let's push that slide and take a look at, if you would, FMLA expansion. Yep, one back, that's it, perfect. This applies to all credit unions, all employers, not only people who have 50 or more employees. It is actually 12 weeks, although everything you'll get from the government says it's 10 weeks. It is 12 weeks of leave. The first 2 weeks can be unpaid, or the employee can use their existing leave, or they can use your emergency paid sick leave that we just talked about for the first 2 weeks. The rest of that 10-week period, the additional 10 weeks, rest of the 12-week period is paid. And again, it's all paid at 2/3 of their normal rate of pay, up to a cap of $200 a day. In contrast to the emergency sick leave, the FMLA expansion only applies for childcare. That is, if the employee has to stay home, cannot work, and cannot telework because they are caring for a minor son or daughter who's unable to go to school because they've closed the school or childcare due to COVID-19 restrictions. Let's flip that to the next slide, please. I'm going to get slide flipping authority one of these days. We don't need this. Nobody here has a healthcare provider. This is one of the things that came down in the proposed regulations 8 days ago. There is a provision in the law that says the Department of Labor should write a regulation allowing small companies to exempt themselves if it really hurts them. Well, the proposed regulation that came down is extremely strict. You cannot exempt yourself if you have 50 or fewer employees, or fewer than 50 rather, unless giving the leave, either of the 2 kinds of leave, would jeopardize the viability of your business as a going concern. Think of how incredibly strict that is. For example, if giving paid leave would result in your expenses and financial obligations exceeding your revenues, and you will cease operating, or if the absence of a particular employee causes a substantial risk because that's the person you need to keep operating. Or, and this is when I knew that we were in a new world, if giving paid emergency sick leave or FMLA leave would leave you with an insufficient number of workers left to carry on your business. So we didn't think that small business exemption was going to be quite so strict. The regulations came out on the 13th. They are very, very strict, and I think it would be very difficult for you to rely upon them, though there are some cases where, you know, the CEO, the CFO, and the COO and the CIO and the CLO all go out to care for their kids. I think you can probably exempt at least some of those from that leave. Anyway, next slide, if you would, please. The other thing that is new, which is, I think, fascinating, the Internal Revenue Service put out a frequently asked questions, question and answer guidance on these two different kinds of leave, and they just put it out yesterday. And there were a couple of things that I think are worthy of notice. The first is that financially, the tax credit that you get for paying these two types of leave is actually better than it looks. The payment of either the 2/3 or the full leave for the paid emergency sick leave, the tax credit that you get, that payment is not subject to employer's share of Social Security tax, and you also get a credit for your Medicare tax paid and for your pro rata share of qualified health plan costs. So you're paying these people to be out on leave, yeah, but not only is the federal government giving you a credit against your Social Security employer taxes of what you pay them, you also get a credit for your Medicare tax paid, and you also get a credit for the share that is being paid for their qualified health plan costs. So this is actually even better for employers than we originally thought. Next slide, please. It's going to be, I mean, the IRS Form 941, you all know what that is. It's a quarterly report of income. Form 7200, which actually came out over a week ago, is a form that you can submit if you have people out on one of these two types of leave, you're anticipating a credit against your employer side Social Security payments, and you want to get the money before the payments are due, or you don't have enough in tax liability to offset the credit. Form 7200 will let you get that money. It's great. That's one thing that I wanted to mention about the IRS frequently asked questions. The second thing is that they snuck in a new substantive requirement. This appears nowhere in the Department of Labor guidance, advanced interim guidance, temporary regulations, interim temporary regulations, interim permanent regulations, or the statute. Okay, this just appeared from nowhere. The IRS says one of the records you have to keep in order to get the tax credit for paying one of your employees who's out on leave to care for a child is you need to have a certification. If the kid is older than 14 years and they're staying home during the day, there must be a statement about special circumstances requiring the employee to provide care. And although this is utterly, I mean, it's not a regulation, it's utterly made up out of whole cloth, who knows where they got it, they didn't get it from the statute or the regulations, it nonetheless makes sense, because if you've been to some of these earlier town hall things, I was making fun of the fact that I could claim this because my high school senior, who will be 17 in less than a month, he will be 18 in less than a month. Oh my gosh, he's a minor kid who's been sent home from school because the school's closed and I got to take care of him. Nah, it's if the kid is older than 14, you need to keep some sort of record from the employee why they need to stay home with a 15 or 16-year-old during the day and why they can't take care of themselves. This is also a good place for me to remind you that when the Department of Labor interim regulations came out, even though the law just says minor child, the Department of Labor added to that, or a child who's over the age of 18 who has special mental or physical conditions that you need to take care of. So it's not just, is the kid over or under 15? Yes, let's go to that next slide, John. You're exactly right. I'm not going to talk too much about unemployment compensation, but I do want to be, especially because we have people here from Maryland, from Delaware, from DC and Virginia. They are all different systems. I only practice with any frequency in Virginia, and I'm not admitted to practice in Delaware, so I don't want to tell you what the rules are in each state. But be very careful with your employees who are being laid off or furloughed and still being paid part of the money that they would get. Let me give you an example in Virginia. In Virginia, if you have an employee who makes $40,000 a year, then their maximum weekly benefit for unemployment is $378. If you pay them $400 a week, that's more than their maximum Virginia benefit, so they can't get any unemployment if you have them on a reduced schedule. Even if that's a grossly reduced salary, they can't get any Virginia unemployment, and accordingly, they are not eligible for the additional $600 a week that the feds are kicking in. So if you pay them $400 a week for part week service in Virginia, they get nothing from unemployment. If you pay them $350 a week, you get the difference between the $350 that you pay and the $378 maximum benefit level, $28, and the $600 from the feds. So if you think you're doing well by your employees by paying them more than the maximum unemployment benefit, you are not. They will actually make less money under unemployment, make no money from unemployment if you pay them more than the maximum benefit rate. The other thing to remember about this is if you have employees who are making, again in Virginia, $40,000 a year, and you pay them nothing and they go on unemployment, poof, they're making $50,000 a year because of that extra federal money. They may not want to come back to work. The final thing on unemployment that I want to talk about is this middle bullet point here. Some people don't want to come back to work because of their fear of COVID-19. In Virginia, the way it looks is that that's now a voluntary resignation and they don't get any unemployment. In Maryland, the Maryland administration has said, we are going to see whether not going back to work is good cause for a voluntary departure. So we don't know how that's going to shake out yet, but I thought that was worth mentioning. And that's all on that slide. The rest of the slides, I think, are just something we've talked about before. What can I ask my employees? And you can go to the next slide because you can ask them anything. Ask them about their health, protect their health. And I want to make one footnote here because we were talking about just a few minutes ago, the Maryland mask rules for retail. Yep, it's true that people who are working in a credit union don't have to wear masks under that rule, plus it's not really this type of retail business that's encompassed within the governor's executive order. But if your employees want to wear masks, they're welcome to. And if you have employees who are interacting with the public, such as having appointments, or I've even had calls from credit unions who have, I never thought I'd see this, employees who go out into the parking lot to give you money. I would love that. I think it's a good idea for them to wear masks, even though it's not required. And again, it all comes back to OSHA's general duty clause here in yellow. What we're trying to do is make sure that we have a safe workplace. We want to protect workers, customers, visitors, and others at the work site. John, I think that's mostly what the updates have been about leave. So I will defer to you. It is 12:01.
John, thank you very much. I want to thank you for all of that, as always, and thanks for always being a resource for our credit unions, or when we have questions, or when folks ask us questions, that we can get a quick answer whenever we need to. So that's greatly appreciated. I think that brings us to the end. I don't have any additional questions. I would like to thank everybody for taking your time to be with us, to join us for our third town hall. We will be doing another town hall. The tentative date is May 6th. It will be one day later. It'll be a Wednesday, same time, noon to, or 10 to noon. And we look forward to engaging with you then. And if you have anything that comes up in the meantime, you'll be getting an email that will also have the contact information on here that I've got up right now, which is our team here at the association, along with those that of our presenters. I want to thank John Cutchy from Region 2, our regional director, Commissioner Salazar, Chuck Fagan from PSCU, the CEO there, and Norm Patrick, and also Andrew Softly. Great information, a lot of information. I know we've been trying to get to all of you. Hopefully you still find this valuable. If you have any questions, any suggestions for our next town hall, please don't hesitate to reach out to us. And thank you very much for your engagement and support. Have a wonderful day. Thank you.